This is Dr. Mihir Shah once again with another video. In this video, we are going to have one final revision of all the practical sums under wealth management. Again, a very important video for all the TYBMS SEM students. So let us see what are the various types of sum that you need to cover up in order to attempt all the practical sum in this particular paper. The very first type of sum is based on long-term capital gains. So let us see how to solve the sum based on long-term capital gains.
Okay, now this is the format for solving the sum based on long-term capital gains. The sum will start with number 1, sales consideration. That is the value at which you're going to sell your property in the previous year. Less brokerage or transfer fees any. So you minus from your sales the brokerage, you will get an answer as a net sales consideration. Now from net sale consideration, number 1, you have to subtract something called as indexed cost of acquisition. It means we need to find the cost price of the property if it would be purchased in the previous year. The formula is cost of acquisition into CII, that is cost inflation index of previous year, upon CII of the year of acquisition. So this is one formula, very simple formula. Practically when you do, it will be having a bit more weightage. You'll understand very easily what is that formula all about. After subtracting index cost of acquisition, the next thing is less index cost of improvement. Again, the formula is similar. Cost of improvement into CI of previous year upon CI of year of improvement. Improvement means if you're doing any renovation on your property. So with that, you can ask for some exemption, or you can say some deduction on the value of your sale. When you subtract your index cost of acquisition and improvement from your net sale consideration, we'll get a first answer called a long-term capital gain. And if after that, if there is any new purchase or new investment made, we will subtract that also, and the final answer what we will get will termed as long-term capital gains. Very simple sum, just 4 to 5 steps and the entire sum gets done. Now before solving the sum, okay, there are a few rules that we need to note down. Number 1, 2001 will be called as the base year. If any house is purchased before 2001, do not consider that value. Consider the fair market value as on 1st April 2001. The improvement before the year 2001 should be ignored. And most of the, it's that the cost of acquisition will only be once in the question, but improvement can be multiple times. Okay, there can be more than one time where you can have your improvement in the sum. Okay, those are the basic rule that has to be remembered. The only thing what you need to know is the format is sale less cost of acquisition less cost of improvement gives you long-term capital gain. Less new purchase will again give you your final answer as net long-term capital gain. Chalo, now let us see how to use this format into any sum, any kind of sum that will be given in the exam.
Okay, now let us see how we solve the sum. We go through the question first. Mr. Raj acquired the house property on 1st March 92 for rupees 2 lakhs. The fair market value as on 1st April 2001 was 2,40,000. The cost of improvement made are as follows. They are giving you 4 improvement: 94-95, 2006-7, 15-16 and 16-17. He sold the house for 1,80 lakhs on 25th Jan 2022, that is our previous year. He acquired new house in the previous year for 58 lakhs. He invested rupees 15 lakhs in bonds in the previous year, and there were some transfer expenses of rupees 75,000. The question is given that you need to compute the long-term capital gain for the assessment year 22-23. The CII are given for various years. That's nothing but the cost inflation index. Now let us see how to solve this particular question. Okay, first the name. We'll note the name as Mr. Raj. His status is he's an individual. The previous year will always be 2021-22 and assessment year will always be 22-23. Computation of long-term capital gain, particular amount. The sum will always start with sales consideration. How much are you selling your property for? So it's given here, he sold the house for 1,80 lakhs. So that's 1,80 lakhs. Less brokerage or transfer charges. So here our brokerage is given here. The transfer expenses was 75,000. So we are going to less 75,000, and that amount what we'll get will be known as net sales consideration. So that will come to 1,79,25,000. Okay, after this our first step is less indexed cost of acquisition. Acquisition means purchase. Okay, so now let us see how to calculate that. The formula is very simple. Cost of acquisition is how much you have purchased for. Is given here. You had Mr. Raj had acquired the property for rupees 2 lakhs in 92. Now the rule was, if a property is there before 2001, we cannot take that value. We'll have to always take the fair market value as on 1st April 2001, which was rupees 2,40,000. So our cost of acquisition is 2,40,000 into, we have CII of the previous year. Now previous year was 21-22, so the CII will come to the CII table. We can see it's 317. So 317 upon CII of the year of acquisition. Now this amount was taken from the year 2001. So 2001 ka rate was 100. So now you multiply and you divide, and that value will be known as our cost of acquisition, which comes to that value will be 7,60,800. That's the first part. Next, less indexed cost of improvement. Improvement is all the renovation that have been taking place on your property. Now the rule is before 2001 we cannot take that, we have to ignore that. So I can see improvements are given. So this is before 2001, ignore it. We'll take the first, that is for the year 2006 and 7. Improvement is 1,20,000. Rule is into CI of the previous year, which is 317, upon the improvement of the year in which it was taken. This is 2006-7. 6-7 ka rate was 122. So you divide and you multiply and divide, and you will get your value as 3,11,803. Same way, second improvement, it was 4 lakhs into CI of the previous year, which is fixed 317, upon the year of CI was 15-16. So 15-16 was, it was 254. So the value will come approximately 4,99,213. And third, we have 3,80,000 into 317 upon, this is of 16-17, the rate is 264. So the value will be approximately 4,56,288. You subtract them all and you will get our first answer, that will be known as long-term capital gain from the net sales. It will be net sale less. Remember, from top to bottom each and every values will be less. So the value that you all should have got would be So it would be 1,58,96,896. This is known as long-term capital gain. From this we will less new purchases. I can see here is given he purchased a new house. So new house, which is 58 lakhs, and new investment, if any. So you are saying new investment in bond. I can see here you have invested 15 lakhs in bonds, so we'll minus even that. So from top to bottom, the only thing what you'll have to do is subtract. So from your long-term capital gain, when you subtract the other two values, you will get a final net long-term capital gain, which comes to approximately will come to 85,96,896. So that is how we need to solve the sum which is based on long-term capital gain. So here we had cost of acquisition, cost of improvement, there were multiple, and also we had something which was purchased and some amount which was invested. This is how you need to solve the sum based on long-term capital gain. This was the first example. We'll be doing another example also. Okay, now let us see the next sum. Raj purchased a house on 25th 698. Now this is before 2001 for 1,50,000. He incurred expenses of rupees 1,50,000 toward cost of improvement on 28 2003. The fair market value as on 1st April 2001 was 8 lakhs. He sold the house in the previous year for 95 lakhs. He purchased a new house for rupees 2,50,000 on 20th March 2022. We'll make this as 25 lakhs. We'll keep this as this. This is 25 lakhs. And the CIF for 2001-2 is 100, 2003-4 is 109, and for 21-22 is 317. Compute the long-term capital gain. So again, name we'll write it as Mr. Raj. Status is individual. The previous year will be 21-22 and assessment year will be 22-23. Sum will always start with sales consideration. That is, what is the amount at which you are selling your house. So here it is given that the house was sold for 95 lakhs less brokerage or transfer charges. Now in this sum we went through the sum but we didn't see any transfer charges, so it's nil. So our net sale consideration will be 95 lakhs. Now comes first less indexed cost of acquisition. Now index cost of acquisition may you will have to first take the value of your property. Now you have purchased it for 1,50,000, but that was in the year 2000, sorry, it was in the year 98, which is not possible to be taken. So we'll have to take the fair market value as on 1st April 2001, which is 8 lakhs into 317, that is by default, because previous year CI is always 317 for the year 21-22. Now this rate was taken, the amount was taken in the year 2001, so the rate is 100. So we multiply, we divide, and we'll get the index cost of acquisition as 25,36,000 less indexed cost of improvement. Again, this is for your renovation, so we can see that there's one improvement made in the year 2003 for 1,50,000, so that will be 1,50,000 into 317 upon 2003 ka rate is 109. Again you multiply, you divide, your value will be 4,36,239. Now there's only one improvement in this sum, so now we'll subtract from our net sale, and the value that we should get is our long-term capital gain. So 95 lakh minus both these values will come up to 65,27,761. From there, less any new purchase or investment. So we have purchased a new house, so less new house, which was 25 lakh. So when you subtract, you will get a final answer as long-term capital gain or net long-term capital gain, which will be approximately 40 lakh 27,761. So this is how we need to solve the sum based on long-term capital gain. I hope everyone have understood. Okay, now we will solve one more sum which is based on long-term capital gain. Okay, so let us see that. CA Nitin single sold the house property on 1st Jan 2024 for 92 lakhs located at Kota. Transfer expenses amounted to 5 lakhs and the above house was purchased on 2004 for rupees 15 lakhs. Single made some improvement in the year 2008-9 for 6 lakhs and in the year 12-13 for 6 lakhs. Compute the amount of taxable capital gain for the assessment year 24-25 and then they're giving you all the CIIs. So the rule is very simple. The format is, first you have to always note down sale less all the transfer charges, okay, less index cost of acquisition less index cost of improvement. You minus everything, you will get your long-term capital gain. So very first thing will come sales less transfer charges. So sales was 92 lakhs and transfer charges was 5 lakhs. So 92 minus 5 lakhs comes to 87 lakhs at your net sale consideration. Then come index cost of acquisition. So that is cost of acquisition which was 15 lakhs. CII of the previous year was 348 and the year in which it was purchased was 113. So when we put into the formula 15 lakhs into 348 divided by 113, we get the answer as 46 lakhs 19,469. Same way we have index cost of improvement. There were two improvements. The first improvement of 6 lakhs in the year 12-13 when the CII was 200. So first one was 2008-9 when the CII was 137. So 6 lakhs into 348 upon 137 and 6 lakhs into 348 upon 200. We get the answer. We total up all the index cost, we put it outside and then we subtract it from the net sales consideration. So final answer after minusing should have been 15 lakhs 12,443. One of the most simplest problem sum and very easy to score. Long-term capital gains. You all can go through it once. Now the second type of sum that you need to cover up is based on set off and carry forward. So let us see what are the rules for set up and carry forward and how to solve that sum. Okay, now before we solve sum based on carry forward and set off, there is this one table that needs to be very well understood. Okay, now very simple. Now the table shows a summary for adjustment of loss. Okay, now this is basically you need to learn if you have to understand what is the meaning of set off and carry forward. Just remember one thing, that set off means a condition whereby you can set off your losses with your profit. Meaning if your profits are more than your losses, you can nullify your loss. And at times where your loss cannot be nullified with the profit, we have to carry forward it to the subsequent years. That's the meaning of set off and carry forward. Now this is a very important table that needs to be understood. Income under salary, house property, speculative business, non-speculative business, long-term capital, short-term capital, race of horses and others. Okay, these are different types of income which are available. Now we need to understand how and when the losses can be set off. Okay, so first thing is loss under house property can be set off against any of the income. Okay, it can be set off against salary, house property, speculative, non-speculative business, long-term, short-term, race, others, everywhere. So you have to remember one thing, okay, loss on house property can be set off against all the income. Second, speculative business loss. Okay, if it is termed as speculative and if there is a business loss, just remember it can be set off against its own income. Okay, speculative business loss can be set off against speculative business ka income only. Others it cannot be set off. Third, other or non-speculative business losses are available. Okay, again it can be set off against everything other than salary. Long-term capital loss can be set off only against itself. Short-term can be set off against long-term and short-term. And loss of owning or maintaining the horse race or race of horse can be set off against the race itself, nothing beyond that. So one should see that for loss on house property, it can be set off everywhere. Speculative business loss only with its own self. Other business with all except salary. Long term with only itself. Short term with long term and short term. and horse race along with its own self. You all can all take a screenshot of this particular table and just learn over it. Very simple. Okay, now based on this we'll see how can this table be used in solving the sum. Now this is the first sum. We'll go through the question once. It is said that Mr. Max is a resident, submits you the following information for the year ending 31st March 2022. Income from salary, income from house property, profit and gain from business and profession, capital gains, and income from other sources. And thereafter it is given that determine the net income for the assessment year 22-23. So now let us see how to solve this particular sum. Okay, first thing they have given us income. Achha, now the best thing, okay, very simple. Just check how we solve this sum. Okay, all the headers which are given to us, we'll note down that one by one. First, income from salary, so I'll note down income from salary, and always see that you note down the amount in the inner column. Okay, after doing that, okay, after noting down the income, you just leave a little space. Now here there is no line, so you can leave a couple of lines in your paper. Then we note down the second one. Now since income of salary is only singles, I'm just putting it inside. Now income from house property, so I'll write here income from house property. Now there is house 1, house 2 and house 3. Okay, the values are positive 70,000, that's income, negative 52,000, that's a loss, and the third one is again a loss of negative 25,000. So the net amount, I'm getting a net amount, it is 70 positive and 77 negative, so I'm getting a negative 7,000 here. So that's basically a loss from house property. Now as per the rule, now we have already learned that the loss on house property can be set off against any of the income. I can see income from salary here, so what I can do here is we can set off this negative 7,000, okay, towards the income from salary. So what I'll write here is, now I'll write here loss on house property to be set off against salary, and I'll write here, so this is getting a set off. So now there is no income from house property, we have made it nil. This negative 7,000 I'll set it off with income from salary, so I'll write here less set off of house property loss, which is negative 7,000. So this will come to, if I minus 7,000, this will become 15,93,000. Okay, so my income from salary, what we did here is house property, it was negative, and the rule was loss of house property can be set off against any of them. So we are setting it off with income from salary, because the income from salary is a huge amount. Chalo, now we do the third one. Third one was profit and loss from business and profession. So I'm writing here from business and profession. So what you can do, I'll just underline this. This is like income from house property. This is income from business and profession. Now here we have 4 business, but under that 2 of them are speculative, 2 are non-speculative. So first we will do first non-speculative. So rule for non-speculative was, again, it can be set off against any of that. Okay, it can be set off against any gain. It can even be set off against its own gain. So business 1 and business 2, they are non-speculative. So income was 2 lakhs, loss was 75,000. So we can set off against each other. So 2 lakh minus 75, income is 1,25,000. Against each other we can set it off. Next was business 3 and business 4. They are they are speculative. Remember, for non-speculative you can set it off against anyone except salary. You cannot set off the loss against salary, but for their own income you can easily set it off. So business 3 and 4, may we have negative 1,60,000 and positive 72,000. Now for these are both speculative. Okay, now for speculative, the rule was that whatever is the loss on speculative, it can only be set off against the profit of the the speculative business itself. But here the business ka income is less than the loss, so we are going to have a loss here. The loss will be 1,60,000 minus 72,000, so that will come up to negative 88,000. Now this is a loss, you cannot set off this with any other income. So this negative 88,000, we will write this as speculative business loss carry forward to the next year. So this is the loss which will be carry forward, you cannot set it off. Okay, next is fourth, that is capital gain. So I'll note down here now, capital gain. Now again we have short term loss and long term gain. The rule was whatever is the loss from gains, okay, you can set it off against each other. Okay, but then other than that it cannot be set off further. So what we'll write here is long term capital gain was 70,000 and short term capital not gain loss was 83,000. So there is a negative 13,000 difference. This cannot be set off against anyone else. You can only set off the short term with the long term, or it's the gain from short term itself, so it cannot go further. So we'll have to carry forward it now. So capital loss will be carry forward for the next year. So that table, you just have to remember the table, and based on the table you can just, so if any losses are there which cannot be set off, it will be carry forward. If it can be set off, you minus and put the amount on the outer column. Last we have income from other source. So in simple term, just to understand what is this whole thing, it's just that income में से you're minusing all your losses. So first is income from card games. It's a pure income, so we'll put it in the outer column. Income from card game is 80,000. Income from camel race, again it's an income, cannot be set off again, you don't need to set it off, so that's 2 lakh in the outer column. Just remember only the losses can be set off and carry forward. Okay, and last is loss on maintaining of the horse. The rule was maintenance of the loss can be only set off with the gains of the horse ka races pe, but then there is no gain. 1,20,000 is a loss, and that 1,20,000 loss will be carry forward. So you write loss on horse race carry forward. Okay, once you finish with that, we just need to total the outer column, that's taxable income. So when you total it, you'll get 19,98,000. Okay, so that is nothing but a taxable income. That's the final answer, taxable income. So this was the first sum under set off and carry forward. Okay, I hope everyone has understood that. To make it more clear, we are going to solve the second sum now. Okay, now this is the second question. Mr. Ajay submits the following detail as on 31st March 2022. Again, we have income from salary, house property, profit and loss from business and profession, capital gain and income from other sources. Determine the gross taxable income of the assessment year, and also complete the amount of loss that can be carried forward to the subsequent years. Okay, so again in the same way, first we have the name and all those details given. So we'll start with first number 1, income from salary. Again the rule is in the inner column, leave little space. Second, income from house property. Rule is if there is a loss on house property, it can be set off against any income. Again, we have 3 houses, so we'll write here house 1, house 2 and house 3, which is an SOP. House 1 is 16,000, house 2 ka it is negative 20,000 and house 3 ka it is negative 12,000. So the net amount for this will be so 32,000 minus 16 is negative 16,000. Now the rule is the loss of on house property can be set off against salary. So I'm going to set it off here. So this becomes set off, so this is gone nil. So I'll write it as less. This is loss from house property set off. So 16,000 will be set off. So 60 minus 16, 44,000 is your income from salary. Third, profit and loss or profit and gain from business and profession. So from business and profession, I underline that. I can see one non-speculative, the other one is speculative. Okay, so speculative and non-speculative can be set it off by themselves. So I have positive 35,000 and a negative 25,000. So I'll write here from business A there is a loss of 25,000 and from business B, which is a speculative one, there is not a loss, there is a profit. If there is a profit, we can set off with each other. So 35 minus 25, 10,000 is the income from business and profession. Next is capital gain or capital losses. We'll have to search that. So we have capital gain, underline it. Short-term capital losses there of 18,000 and long-term capital gain is there of 10,000. Again, loss is greater, so 8,000 is the difference, the loss. Now this short-term loss cannot be set off, so it will be carry forward to the next year. Okay, so it will be carry forward in the next year. Fifth is income from other source. Now under income from other source, we have income from betting, so that's an income. Now since there are a lot of other sources, I'll write this in the inner column. In interest on securities gross, so that's again an income, so the interest on security, which is 18,000. Now interest on loan borrowed, that's negative. Okay, so that's like a loss. So interest on loan borrowed is a negative 20,000. Now this can be set off. Okay, these can be set off against each other. So 20 minus 18 is 2, and then we have 18 minus 20 is negative 2, and negative 2 and positive 9 will give you a positive 7,000. And lastly, the loss from horse race. Now that can't be set off against each other. So we write loss of horse race, which is a negative 12,000. Now this negative 12,000 will have to be carry forward. So we write loss of horse race carry forward to the next year. And thereafter, whatever income we have got, we will add it up. So it is 44,000 plus 10,000 plus 7,000, that comes to 61,000. So that's our taxable, or the taxable income. That's our final answer. net taxable. Here they have asked us to find the gross taxable, so this will be a gross taxable income. So this is how we need to solve the sum based on set off and carry forward. Okay, now the next type of sum, that is type 3, is computation of net tax liability and deduction under chapter 6A. So let us see how to solve the sum based on net tax liability. Okay, now let us see how can we solve the sum based on computation of tax liability. Now there are two steps that needs to be followed. Step number 1, we need to first compute the net taxable income. Now under this there are two parts. First, under this we need to add all the income from various heads, that is income from salary, house property, business and profession, long-term capital gain and other sources. So whatever incomes are given, you add it up. Next, you need to less all the deductions under chapter 6A that comes under section 80C, 80CCC, 80U, 80D, double D, 80E, TTA and TTV. Now all the section there is another sheet which I have prepared so that you can easily remember all the deduction within couple of minutes. Okay, so that's step number 1. We need to find net taxable income. Second, we need to do the computation of tax liability based on the tax slab. So under this we need to compute the tax liability based on the tax slab. 3 different tax slabs are there. One for less than 60 years, second for more than 60 but less than 80, and third 80 and above. Usually it is more or less asks always of 60 and 60 and 80. Okay, so remember, up to 2.5 for less than 60 years, up to 2.5 no tax, from 2.5 to 5 lakhs 5%, 5 to 10 20%, and above 10 30%. For 60 to 80k range में up to 3 lakh no tax, 3 to 5 5%, 5 to 10 20%, and 10 and above 30%. And if you are super senior citizen, up to 5 lakhs nil, 5 to 10 20%, and 10 and above 30%. So this is the tax slab which you need to remember. Okay, now let us see how to remember the various sections under deduction under chapter 6A. Okay, now there are 8 important deductions that need to be learned under the chapter 6A. Number 1 is under section 80C. Remember the alphabet. Okay, C stands for contribution. Contribution is like you are making a payment towards some investment, or you are buying something, you are contributing. Under that usually includes your provident fund, NSC, FD for 5 years, mutual fund, etc. Remember the maximum limit of 80C is you can ask for a deduction up to 1,50,000. The second is section 80CCC. CCC mein only one thing will be there, that is pension plan of LIC. Okay, now remember section 80C plus 80CCC together should be 1,50,000. You cannot ask for amount more than 1,50,000. The total deduction that can be asked under 80C and CCC together or individually is also 1,50,000. Next comes is section 80D. Remember D for dawai. Dawai means something related to mediclaim. Okay, so D is for dawai. For self, spouse, child, parent, 25,000 rupees ka deduction you can get. And if there is a senior citizen, you can get extra 25,000 rupees. Just remember, mediclaim has to be paid by check only, then you can ask for this particular deduction. Next is 80 double D. Double D ke liye remember the word dardnak dependent. Okay, there is a diseased person, a very dangerous disease, and he is a dependent person. So if there is a dependent handicap in the family, then if the severity is less than 80%, you can get 75,000 ka deduction, and if it is more than 80%, you will get 1,25,000 ka deduction. The severity level will be mentioned in the question. 80EE is for education. 100% of interest value will be deducted from the loan that you have taken for higher education. 80 TTA and TTB, both of them are basically for saving bank. Remember, A is for normal people. Okay, you get a limit of 10,000 rupees. TTB is for senior citizen, and you get a deduction up to 50,000. And last is 80U. U stands for you. Okay, if you yourself are handicapped, then again, if your severity level is less than 80%, you get 75,000 ka deduction. If it is more than 80%, you will get 1,25,000 ka deduction. So these are the various deductions that you have to keep in mind. 80CC is for contribution, D is for dawai mediclaim, double D is darnak dependent, E is education, TTA, B is saving account interest, One is for normal, one is for senior citizen, and U is for your you yourself. If you are a handicap, then you can get that particular deduction. Okay, now based on these two, let us see how to solve the sum. Sum is very simple. Okay, let us see how to start with the sum. Okay, it is given here now. The following are the details of Mr. J for the assessment year 22-23. Income from salary, income from house property, income from other source. He made the following payment: mediclaim and contribution to NSE. Compute taxable income and tax liability after deduction under chapter 6A. Okay, now let us see how to solve this particular sum. Again, sum is divided in two parts. Number one, we need to first do the computation of net taxable income. Under that, there were two steps. First, you add all your income. Second, you subtract all the deduction. So let us see what all incomes are there. I have income from salary. So we'll note down here number one. So we write income from salary. The amount is 8 lakhs. Second was income from house property, that is HP, 3,40,000. And third one was income from other source. So income from other source, amount is 2 lakhs. So these are my three income which I have. So I will add all the incomes. So it comes to, I have 8 lakhs plus 3,40,000 plus 2 lakh, that comes to 13,40,000. That's gross taxable income. Now from this, less deductions under chapter 6A. Now very simple. First is mediclaim. Mediclaim is dawai. Dawai comes under 80D. So under section 80D we have mediclaim. Remember, okay, it's very simple to remember. Just remember the codes. Now 20,000 was paid in check, 5 in cash. Rule was if you are making payment in check only, then it will be allowed as a deduction. So we'll only consider 20,000 deduction. Second is NSE. NSE is investment you're making, so it comes under 80C, that is NSC, which is again 20,000. So and the maximum limit is 1,50,000, so this amount is less than that. So total is 40,000, which is we'll have to less from your actual. So 13,40,000 minus 40,000 will give you 13 lakhs. That is nothing but your net taxable income. Okay, so that's the step number one. We need to find the net taxable income. So the value is 13 lakhs. Now we need to start with the computation of tax liability. Now tax liability ka tax slab, now we assume, since they have not mentioned anything, so we assume is less than 60%, 60 years. So up to 2,50,000 the tax rate will be nil. From 2,50,000 1 rupee to rupees 5 lakhs it will be 5%. From rupees 5 lakh 1 to rupees 10 lakhs it will be 20%, and above rupees 10 lakhs it will be 30%. Now 13 lakhs, what is the income? Now we have to break that and show us. Okay, so up to first breakup will be 2.5 lakhs, under which the tax will be nil. The next 2,50,000 pay, you have to take 5%, that comes to 12,500 rupees. On the next, now 5 to 10, so that's next 5 lakhs pay. Next 5 lakhs pay, you have to take 20%, that comes to 1 lakh. And above 10, I guess, so we have 3 lakh because total was 13 lakhs. So 3 lakhs पे we have to take 30%, so which comes to 90,000. So when you add it up, that will be the gross tax liability. So 12,500 plus 1 lakh plus 90,000. So it comes to 2 lakh 2,500. Now towards this we need to add education and health cess of 4%. So 2 lakh 2,500 into 4%, 2 lakh 2,500 into 4% comes to 8,100. We will add that to your gross tax liability. So our net tax liability is 210,600. This is how we need to solve the sum based on tax liability or calculation of tax liability. Okay, I hope everyone have understood. The next type number 4, is based on advanced tax liability. So let us see how to calculate a sum based on advanced tax liability.
Before solving the sum, this is one table that need to be learned. Okay, the table heading is due date for payment of advanced tax. Now it is said that the due date, if it is on and or before 15 June, okay, the amount which is payable, that is the installment payable amount, will be 15% of advanced tax liability. If it is paid on or before 15th September, then it will be 45% of the advanced tax liability. If it is on or before 15 December, it will be 75% of the advanced tax liability. And if it is on or before 15th March, then it will be completely 100% of the liability. So this is one table which needs to be thoroughly learned. And now based on this table, let us see how to find the tax liability.
Okay, now let us see how to calculate or how to solve sums which asks us to find the advanced tax liability. First, we'll read out the question. It's given that explain the liability for advanced tax payment of Mr. J, whose income is estimated to be rupees 8 lakhs during the financial year 2021-22. Now, this is the statement which has been given to us. Now, and based on that, they have asked us now to calculate the advanced tax liability. Now, we will solve the sum in 2 steps. Step number 1, we need to first calculate the tax liability of Mr. J. Okay, so you'll have to give the heading as tax liability of Mr. J, and then you have to create this table. Table will include your tax slab, assuming that he is less than 60 years. We have the tax slab, we have the tax rate. We need to note down the income, and then we'll have to find the tax liability. Okay, so now our tax slab states that from 0 to 2.5 lakhs, no tax. From 2.5 to 5 lakhs, 5%, 5 to 10, 20%, and 10 and above, it will be 30%. So now we need to split our income that they are given us, that is 8 lakhs, okay, under the following heading. So now look here, 8 lakhs will be divided as first break will be at 2,50,000. So from 8 lakhs, 2,50,000 has been removed. So now 5,50,000 is remaining. So from that 5,50,000, next 2,50,000 will be considered. So now we have 2,50,000 plus 2,50,000, that's total 5 lakhs. Total we had estimated income was 8 lakhs. So another 3 lakhs are pending. So that will come in the next. Okay, that's it. So 5 plus 3, 8 lakhs. So there's nothing beyond 10 lakhs. Okay. First step, we broke the income in the specific slab. Now multiply with the rate and get the total tax liability. So first 2,50,000 pay, first 2,50,000 pay, there is no tax, so it will be nil. On next 2,50,000 pay, it is 5%, so that comes to 12,500. And on the next 3 lakhs pay, it is 20%, so that comes to 60,000. And thereafter there's nothing. So the total tax liability, the total of the tax liability that we got is 72,500 500. Now the rule is whatever tax you have been calculated on that, we need to add 4% of health and education cess. Okay. So 72,50,000, I mean 72,500 into 4%, that comes to 2,900 rupees. So that amount should be added to our 72,500. So the total amount that we will be getting now is 75,400. That's our total tax liability. So Mr. J will his tax liability comes up to 75,400. So very simple. First you need to break the income, multiply with the rate, get the tax liability, add it up. Whatever gross total you get on that, add 4% education and health cess, add up, and you will get your total tax liability. Now that's step number 1, get the tax liability. Step number 2, we need to calculate the advance tax. Now for advance tax, there's another table that we need to draw. First we'll have your due date, the rules. Okay, so on or before 15 June, okay, 15 September, 15 December and 15th March. Okay, now since this year is 2021-22, so it will be before 15 June 2021, 2021, 2021, and March will be 2022. Okay, now let us see the working. Okay, now the rule states that the due date, okay, if it is on or before 15 June, the advance tax liability will be 15% of the net tax liability. So it will be 55,400 into 15%. Okay, so we will multiply and check what value we get. So into 15%, we will get the value as 11310. Okay, so our very first installment, we'll keep that as an installment value, so it will be 11310. Next, if it is paid on or before 15 September, okay, it will be net, the tax liability into 45%. So now 5,400 into 45%, the value will come to 33,000. The cumulative value is 33,930. So now that's the cumulative value, because that has 15 also included in that. So we need to get the total installment value. So installment value is nothing but the first installment minus the cumulative. So it will be 33,930 minus 11,310. So that comes to 22,620. Or you can even subtract the above value. Okay, so you'll get the same difference. Now third, if it is paid on or before 15 December, it will be your tax liability into 75%. So again 75,400 into 75%, that will come to 56,550. You minus 33,930, that's the previous value. Okay, that's the previous amount. You minus the cumulative of the previous, you will get the installment value, which is 22,620. Okay, and the last, if it is paid on or before 15 March, okay, it will be the full value that you will have to pay, that is into 100%, that is again 75,400. Okay, and now from that, if you minus, so you take 75,400 on a calci and minus 56,550, that's the previous cumulative total, you will get the total as your installment value as 11,850. You add up all your installment, that should come up to 75,400. Okay, now the total tax is 75,400. So now we'll have to give a small conclusion. Okay, so we'll say that since Mr. J income is 8 lakhs and the tax on that comes to 75,400, which is more than rupees 10,000, that's the threshold limit. Okay, therefore Mr. J is liable to pay advance tax. So we'll write here, since Mr. J income is 8 lakhs rupees and tax liability is 75,400 rupees, which is more than 10,000 rupees, which is more than rupees 10,000. Therefore, Mr. Jay is liable to pay advance tax. Okay, so this is how you need to solve sums which are based on advance tax or based on calculation of advance tax liability. I hope everyone have understood. Now the last type of sum, that is type number 5, is based on ratio analysis. Now in order to solve sum based on ratio analysis, first thing you need to know is all the various ratios. Okay, so here are the first set of ratio that you need to go through and learn. So I'm giving you a couple of seconds just to take a screenshot of it and then note it down. Okay, along with that, there is one more set of ratio that you need to cover it up. Okay, once all have noted down these ratios, now we can go ahead and solve the sum based on ratio analysis. So let us see how to solve sum based on ratio analysis. Following is the balance sheet of Alok Limited. Find out the current ratio, liquid ratio, debt equity ratio and capital gearing ratio. So they're giving you a balance sheet and they ask you to find those 4 ratios. So let us see one by one. The very first thing is current ratio. Formula is current assets upon current liability. So I've written the formula here and the solution. So current asset, let's see what all will come. We have stock, we have debtors, we have bill receivable, we have prepaid expense. 4 things. In current liability, we have outstanding wages, trade payable and bank overdraft. So 2,40,000 and 11,000. So we add up. Okay, and when you divide, you will get your first answer as 1.793. So in this, basically, you just have to remember the formula very carefully and what comes under each heading. That is the most important part. Next is liquid ratio, that is quick assets upon quick liability. Okay, so very simple. In quick asset, you only have debtors and bill receivable. You do not add stock and prepaid. And under quick liability, other than bank overdraft, the other 2 things. So we have trade payable and outstanding. So again, we add up, we divide, we get the answer as 1.125. Next is debt equity ratio. Formula is debt fund. So in this, debt fund is 3,30,000, that's bank loan, upon equity fund. So equity fund we have equity share plus preference share plus all the profits, reserve and surpluses, less preliminary expense, that is fictitious. So basically, debt equity, in that equity fund you have your net owners fund. Okay, so net owners fund is everything. We have equity share plus preference share plus reserve and surplus less all the fictitious assets. Okay, so we add up, we divide, we get the answer as 0.324. Last is capital gearing ratio. Capital gearing ratio ka formula is debt plus preference share upon equity fund. Okay, now see here in debt equity we have equity fund, that will be basically total owners fund. Okay, whereas under capital gearing, since preference share has already been used up in the numerator, instead of preference share everything will come. So debt is 3,30,000, preference share was 1,50,000, that's the numerator. Now for the equity fund, you have to only take equity part. So equity 8 lakh plus reserve and surplus 89,000 less fictitious 20,000. So you add less, okay, divide, and we get the answer as 0.5523. So this is how you all had to solve the sum based on ratio analysis. You all can go through it once. Okay, so these were all the different types of sums that you had to cover up under wealth management. Chalo, I hope everyone have understood it. With that, we'll be ending this video here. Thank you.